In fact, central banks are trained to look through such volatility in markets. They know better than anyone that a lift in petrol, such a savage lift in petrol, acts more like a tax on consumers than anything else. So households are just facing yet another lift in inflation, yet another cost of living crisis that we've been fighting for over 3 years. So this is actually quite damaging for the growth outlook. It's not something that a central bank should be hiking into. Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwi Bank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it. All right, kia ora koutou and welcome to another episode of Markets, Mystics and Mayhem. And we have some mayhem in markets for you. Just last week, there was an attack on Iran, and the war in the region has spread like wildfire, causing all sorts of complications and threats, I guess, to the global growth outlook. An amazing turn of events, really, a massive escalation in attacks from Israel and the United States and the retaliation across the Middle East. Can you just tell us, what are some of the key things we're looking at the moment?
Well, I think the biggest thing here is the energy markets, right?
Yeah.
Oil and liquefied natural gas, because what we're seeing right now is that the strait that is between the Persian Gulf and Oman Gulf, I believe it is, known as the Strait of Hormuz. That's where about 20% of all our oil and gas trade pass through. That's essentially come to a halt, shipping there, given the conflict. So you can immediately imagine the impact that has on oil prices, and we have seen a massive move in oil prices. When the conflict happened over the last weekend, all markets were kind of watching where oil prices would go. We kind of shot up to close to $80 a barrel on Brent crude. But then we kind of just stayed there at 80 USD. We kind of tried to get up to 85, and we're just kind of in a bit of a choppy range.
It took a while.
And 80 to 85, obviously that's lower than this low 70 range we were trading in before. But that's not really a high oil price. So we're like, okay. But then as, the conflict has gone on with no signs of de-escalation and has actually escalated, oil prices have actually surged even higher. It also, doesn't help that you've had reports that Iraq, Kuwait, and what was the other country? Oh, the UAE. They're stopping oil production or halting some of their oil production because they just don't have the storage facilities with that strait being closed and not being able to transport it. Then you also had reports of China actually saying that they're going to halt refined oil exports. And so all of that combination has really seen US oil prices, or at least Brent crude prices, take another step higher. We ended the week at just over 90 USD a barrel. And then we opened this morning and just surged even higher. I think, we checked just now, and it's probably maybe going to be out of date by the time we
by the time we get this out,
published, but it was at 108 USD a barrel, which we did say last week. We were thinking, 85, 90, even that's quite low. We were sort of expecting it to break above 100 and then, potentially push into 115, 120 range, which is where we're heading. And it's where we kind of got to during the Russian and Ukraine conflict in 2022. But yeah, there's going to be some pain there, and markets are starting to think, okay, there's going to be an inflation shock. Do you want to talk to that? I don't want to steal your thunder there. Yeah.
No. I mean, the move, like you say, it's 108, 109 now. I mean, I've had it in my mind that such a conflict's going to see oil break that sort of 115, 120 range, like we saw when the Ukraine war broke out. I think this is worse than the Ukraine war. It has a greater impact on oil prices. The Ukraine war had quite a large impact on grains and agri commodities. This one this particular conflict, not good for the oil market at all. And what we're hearing a lot of from commentators, particularly journalists, is this knee-jerk reaction that, okay, the oil price is going to go from here to here, which means the petrol price is going to go from here to here, which means inflation's going to spike. Yes, that's true. That will happen. It is happening. And then they make the next step and say, well, that means central banks have to start hiking interest rates. No.
Wrong. Sorry.
No, that does not naturally happen. In fact, central banks are trained to look through such volatility in markets. They know better than anyone that a lift in petrol, such a savage lift in petrol, acts more like a tax on consumers than anything else. So households are just facing yet another lift in inflation, yet another cost of living crisis that we've been fighting for over 3 years. So this is actually quite damaging for the growth outlook. It's not something that a central bank should be hiking into. If anything, it might be something that a central bank may have to cut into.
Yeah. Although, like you say, so that's what central banks should do and we expect will do. But you do have, commentary saying this is going to be a hike. And you've even got markets pricing it up that way. Like we've seen a bit of a lift in global interest rates. Again, not as much as you'd probably expect with such a conflict, but we have seen a lift in global rates. The Kiwi rates as a response are also lifting. I think, if we look at the market pricing for when the RBNZ next move is, after the RBNZ meeting in February, we got markets where they needed to be. They were just pricing in one hike for this year. At the end of the year in December, we thought, okay, fair enough. But I think given these moves, markets have started to price in. I think they've got maybe 2 rate hikes again priced in, and I think early as October. That's not good. That's putting pressure on your wholesale interest rates, lifting them up. But as you say, a central bank should be looking through this as more of a demand shock on an already weak economy, that is struggling with the consumer. And as we say, consumption makes up 60% of the economy's growth, basically, or activity in the economy. And it does act like a tax on households, which we were already seeing that kind of tax on households happening from increased elevated prices across essentials. We looked at it in our Kiwi bank spending data, food, council rates, energy rates.
Administered prices.
Yeah, and now you're going to add oil prices at the pump on top of that. You're just going to see that the household budget is going to be coming under even more pressure.
It's another essential item that many households just have to spend, otherwise they can't get to work.
Yeah.
And that's just going to eat into their budgets, right? So there's a very inelastic, supply curve and demand curve for petrol, right? And it's going to hurt. And again, it's not fair. It will hurt lower income households much more than it will higher income households. And the Reserve Bank just has to step back and look at that and go, okay, there's been a spike. Will it feed through into expectations? Yes. How bad is that? And we can deal with that later on. To be honest, that we could deal with that in 2027 if we have to. Otherwise, there's a spike in inflation, and then there's a drop in consumption. There's a larger output gap. There's a New Zealand economy which is struggling once again to recover. I just don't understand why you'd be hiking into that. If anything, there could be rate cuts. So this is where we differ from most of the commentary that I've seen, particularly on the news. I actually think they're misreading what is a very damaging price move throughout New Zealand's little economy.
Yeah, and then even from a business perspective, yes, there's going to be pressure coming through on input costs, right? But given the sort of weak environment that we're still trading in, that many businesses are trading in, is how are they going to lift? Yes, their costs are going to go up, but do they have the ability to pass through those costs? Because we know that price setting ability is still quite weak for many. Obviously, it's going to be uneven. That some of the sectors that are maybe more recovered now will be able to pass through some of that cost. But you look at a sector like, retail clothing and apparel, which has just been seeing declines in volumes and values there in terms of what Kiwi are spending on. How are they going to, actually be able to pass on the costs there? Well, I don't think they will be able to. It's going to be a hit to margins potentially for many, to profitability. And under that environment, that just seems, and also just the fact that there's more uncertainty again, you're just going to see businesses pulling back even more, which is just going to reinforce this, downwards weak economic environment that we're sort of leading into, that we haven't really fully come out of yet. So yeah, it is seeming like there's a bit of a misread. I think it's just because people focus so much on, inflation's going up, that means that the central bank has to hike.
Yeah.
But it's the type of inflation that we're seeing because it's very driven by this negative supply shock.
Yes.
And how it's an increase in an essential item. It's just going to impact a little bit differently. The near-term impact is, yes, higher inflation, but medium-term, where policy is really set for, well, the risks to global growth there are huge.
Absolutely. And you think about the obvious, which is, the price of petrol goes up, that hurts households. But like you say, it hurts many businesses because the price of oil goes into just about everything, right? We do a lot of transport. We do a lot of shipping and flying of goods around. So prices of airfares naturally go higher. So the cost of travel, cost of business travel, the cost of tourists coming down here, to God's country to have a look around. It has a negative impact on large parts of the economy. And it depends on how long this lasts, but it is worrying from our point of view. The back of my mind, I guess what I'm hoping for is that we get such a aggressive move in financial markets, and it will go further. 109 is not the top. It's probably 120, could go to 130. We get that move, and then the political pressure on Trump and others to end things quite quickly, I'm hoping will cause him to back down. I don't think it would be too hard, over the next few weeks for the Trump administration to turn around and say, you know what, we've actually achieved what we wanted to achieve, and we're kind of hoping that in 6 weeks' time we wake up and a lot of this has been reversed. But I guess that is on the optimistic and hopeful end of the spectrum.
I mean, sometimes optimism is all you've got, right?
Well, it's kind of what we're looking to.
But I think you're right in terms of, we know that Trump has been prone to just kind of pivot when markets start to give him a bit of pressure there. So I think it's not an unusual move that would come out of this. I mean, we saw the same thing in Liberation Day, right?
Yes.
When equities, dropped significantly. There was a lot of pressure there for Trump to kind of unwind some of his Liberation Day tariffs. It's that taco trade, Trump always chickens out kind of vibe. I mean, obviously very different circumstances, but I could definitely see a world where that pressure from markets really has to, play a role and pivots him out of it.
The whole Trump chickens out thing, fine, you can say that all you like, but if you actually look back on a lot of things, he has got what he's wanted. And that whole Liberation Day, you come out and you say, I'm going to put 150% tariff, right? You get a whole lot of negotiating that goes on behind the scenes. You get what you want, and then that 150 drops and it drops and it drops. And we're all ended up and around this 10 to 15% level, which we as academics will tell you is, the right size tariff. 10 to 15%, you actually generate a fair amount of revenue because you're not diverting trade. So you do these scare tactic things. You get what you want along the way. You get a depreciation in the US dollar, which he wanted, right, to make US manufacturers a little bit more profitable. So if he can look at the Middle East and we've got rid of the leader, we've done this, we've done that, and he can sort of hand on heart say, I've done something, whatever that is, I don't care, just want him to say that he's done something, and then step back. That's quite important. For him to be sitting there and thinking, I need to do more, need to do more, need to do more, it's not a good thing. I think we'll get to a point where hopefully that all flips on its head and he's like, well, I'm happy to step back now. I did promise peace in the Middle East. It's like you promise peace in the Middle East with how many thousand missiles?
Yeah, and unfortunately that's kind of where we are right now, where there haven't been any signs of like the slowing down yet or
Not yet,
de-escalation,
no.
which is why we think markets, definitely could push higher from
Absolutely.
here. We haven't seen, shipping indexes respond too much yet. That might be
It's
a
a
bit
surprise, right?
Yeah, I wonder if it's just a bit lagged, even in the way that oil prices seem to lag a little bit on the way up.
Yeah.
Maybe just because markets were, we've had one volatile event after the other. And we've talked about this before, that markets were becoming a little bit numb to sort of these headlines and maybe just, being accustomed to this being like this level of volatility being the new norm.
Yeah.
I think we've now pushed past that a little bit, but maybe it's why we haven't seen the supply chain reaction too much.
I just don't think it's been reflected in the data that we've got. I mean, we've got data up until today, and we haven't seen a move higher in shipping costs, but it's happening, right? If you're having to divert around, that's costing you more days, more time,
and the insurance premiums too, of being in these dangerous waters potentially, right?
100%, and the price of petrol itself and moving these big tankers, so that's got to go up. That's got to feed through into inflation. And, I think I read somewhere that we send about $3 billion of our exports through that strait. That's quite material. The Cyclone Gabrielle wiped out $1 billion in our exports and took us years to recover. And now there's potentially $3 billion that has to be diverted elsewhere and mucking around, but that'll come to the buyer at a higher cost.
Yeah. So it's a bit of a hard position because, we've been saying that we're hopeful for this year to be a better year like we always do. We were optimistic.
Yeah.
And this just throws another spanner into the works, which is, it's a very frustrating and upsetting and painful one for Kiwi households and businesses.
Well, they're sitting there with yet another source of volatility and uncertainty, and they're trying to make decisions. And there's an election coming up. They're nervous about that. Now there's a war in the Middle East, which is causing all sorts of havoc to their supply chains and the cost of what they do. You know what? I was thinking of buying that machine, or I was thinking of moving into that larger warehouse. Maybe I don't, And again, I was thinking of hiring that person back. Maybe I'll wait. And it's that waiting, it's that postponing that, by definition, is just killing growth. And we just really didn't need it. It's come at a horrible time for the New Zealand economy because we're in such the early stages of this recovery. To have another whack of volatility and uncertainty is just going to hit Kiwi businesses and households. And we've got a really good interview coming up with one of our Kiwi Bank customers who sort of expresses very similar sentiment, right, around the uncertainty.
Yeah. And, being in an industry like, you'll get to see this episode in the next coming days or so, but being tied to the housing market and the construction industry, that's a sector that I would argue probably hasn't even started to recover really.
Not really.
Maybe just found its footing, but that's about it. And now you just have this extra weight bearing on them. It's just a really, really difficult, and I guess it's just a difficult time. And I mean, it's frustrating that on top of all of that, you've got media coming out and commentators being like, okay, rate hikes because inflation's going up. Like, that's not the message.
It's not the message. No, it's not. I think that's the main thing we just wanted to say today, is there is a lot going on and we're still digesting it. We're still trying to figure out exactly what it means. But from our point of view, the influence on demand, we've had this supply shock, which pushes prices up. The impact on demand, I think, outweighs the upside risk to inflation. So let's get that across. Let's hope the Reserve Bank comes out with a similar message. Hey, we can look through this. We're more worried about the downside risk to growth. We're more worried about the Kiwi recovery. That'll strip out a lot of those rate hikes that you've mentioned are being built back into the curve. that'll strip those back out. We'll have another bet with our traders and hopefully win another cake.
Yeah. Touch wood.
Touch wood. So with any situation like this, we're going to be monitoring it closely. Every morning, I'm going to get out of bed, just that a little more fired up than usual. Bit of volatility. Love a bit of volatility in the morning. Smells like burnt rubber. Gets you going. It's going to keep us going for however long it takes. But that was it from us. Rate hikes, no. Rate cuts, well, maybe. Please like, subscribe, forward it to your friends.
This is important news, actually. This is really the
cool
message
stuff
here that around this whole rate hike story. Because I just want to I know we're closing out, but I want to re-emphasize how hard it can be looking at the media and how they're taking this in terms of the rate hike story. That alone, can be damaging to what businesses do from here, what households do from here. If that's not the case, well, households and businesses should know that actually maybe interest rates aren't going up from here.
Yeah.
So it is a really important message. So yeah, definitely forward along to a friend. I just had to say that.
Yeah, cool. And we're not going to be replaced by AI in these worlds. No.
Where'd that come from?
I don't know. That's it from us.
That's us.
Thanks for joining. You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwi Bank.